My name is Xavier Martin. I'm Deputy Director at the Digital Frontiers Institute, and I will be moderating this session today. This morning or afternoon, depending on where you are, I have the pleasure of introducing Peter Zetelli, Senior Financial Sector Specialist and Team Lead for CGAP, a global partnership of leading development organizations that works to advance the life of poor people, especially women, through financial inclusion. Peter has extensive experience in inclusive payments ecosystems, particularly in Africa, where he lived for a decade. Today, we are going to talk about the great unbundling and how banking is changing and what it means for financial inclusion. We will start out by watching a presentation, and then we will open it up for questions. So please be thinking about the comments and questions you might have and leave them in the chat. So without further ado, we can start the video.
Thanks everyone for joining the session today, and thanks to the Digital Frontiers Institute and the Alliance of Digital Finance Associations for inviting me to come and speak. My name is Peter Zetelli. I work for CGAP. We are a think tank housed in the World Bank focused on financial inclusion, and we've been studying the evolution of banking for many years. What we're going to be talking about today represents a major shift that is underway in banking that has real potential implications for financial inclusion. And that is the unbundling of financial services and the embedding of the services that enables. The backdrop for this conversation is the rise of various digital technologies and business models that are enabled by those technologies that have already disrupted multiple industries around the world. That includes smartphones that have created low-cost digital channels straight to consumers. It includes cloud technology that reduces barriers to entry and barriers to scale. It includes APIs that make it easy to plug and play software components together. It includes software as a service business models that are sort of the commercial equivalent of cloud and APIs, and that they make new solutions cheaper to launch, easier to scale, and more flexible all around. It includes artificial intelligence and machine learning that enables entirely new capabilities in analytics, prediction, machine vision, voice interaction, and so forth. And it includes platform models that have shown that huge value can be created by simply linking together others efficiently. These are forces that have already disrupted multiple industries around the globe. Spotify, Uber, Airbnb, Amazon, Alibaba, all are great examples of that. And there is every reason to expect that these forces are going to reshape the financial industry as well. One way they're doing that is by just obliterating barriers to entry in financial services. The cost of launching a tech startup has fallen dramatically from $5 million at the turn of the millennium to $5,000 10 years later. And that unleashed a wave of innovators creating startups, just as global funding for fintech absolutely skyrocketed from $4 billion in 2012 to $215 billion in 2019, to the point where fintech now represents a quarter of all venture capital deals worldwide. And the combination of dramatically lower cost and dramatically more funding has meant an explosion of fintech challengers looking to reinvent financial services. And that's had huge implications for financial products as well as for financial processes. On the product side, every part of what a bank offers consumers is now being challenged by a whole host of fintechs trying to do it better. Whether you look at payments, savings, lending, insurance, investing, in any aspect of banking, there are dozens of players offering consumers what they think are better products than legacy banks. And there are a few reasons banks need to be worried about these new challengers. Firstly, they're using cutting-edge technology that can be hard to keep up with for banks who still use COBOL and programming languages from 50 years ago. Secondly, they focus typically all of their creativity on one specific customer problem, as opposed to banks who are trying to do everything. And third, they tend to embrace the Silicon Valley product design ethos, not just the clean and intuitive interfaces, that's the superficial part of it, but the lean and agile and DevOps methodologies under the hood on how they develop and run those products. And that makes them very different companies from the legacy banks that they are challenging. For consumers, however, That's great news, because what it does is let consumers assemble their own personal suite of products from different providers. So sort of a Swiss Army knife of financial solutions customized to your own particular needs and preferences. So products are being unbundled on the front end. That's creating more consumer choice, more consumer value, and driving radically sharper competition between providers. Now, the same thing is actually happening on the back end of banking as well, and the processes required to produce financial services. So if we map out a stylized picture of the banking value chain, in the old days, banks largely did all of these things by themselves in-house in these vertically integrated value chains. But today, we're seeing highly specialized B2B fintechs that are creating best-in-class solutions for every single piece of the value chain. And again, they're using cutting-edge technology. They're laser-focused on one specific process or problem. They are embracing modern product design, philosophy, and methodology. And these companies then pursue scale, not vertically, but horizontally, across a large number of financial service providers that they all sell their solution to, which creates economies of scale, which generates more data, which in turn deepens their effectiveness around that piece of the value chain, resulting in lower cost and higher value in the end-to-end chain. And what that means in turn is that actually banking itself is becoming disassembled into its constituent parts, where financial service providers are increasingly able to swap out old gritty pieces with new shiny fintech ones provided by third parties. For instance, to improve digital onboarding with biometric solutions from companies like Onfido or Jumio, which are now big players in the banking space. And that all makes financial services more modular. What we mean by that is that banking processes are effectively becoming a set of Lego blocks that providers can plug and play pretty easily and rearrange in different configurations with a great deal of flexibility, even in real time. But here's the kicker. It's not just banks that can do this. Any company can plug in financial products or financial processes into their existing digital offering. And that is what we call embedded financial services. So what does that actually mean in practice? What does it look like? What does that have to do with financial inclusion, most of all? I'm going to try to answer that in a couple different ways through the rest of the presentation. But the first thing I want to do is show you a short video that tries to speak to those questions.
Technology is changing banking at every level, potentially transforming how low-income people and businesses engage with the financial system. Like Farida. Farida runs a small clothing business in Jakarta, Indonesia. She uses a social media app to market her products. She also has a mobile money account that she uses to receive payments, pay suppliers, and buy airtime. However, she can't get a loan to expand her business or sign up for a savings account to pay for her daughter's schooling. Many financial services are just too expensive and hard to access. Farida's situation isn't unique. Hundreds of millions of people worldwide live with similar circumstances every day. That may be about to change. Historically, even people with a bank account tended to only use a single provider that offered them a limited menu of its own products. Thanks to new technologies, there has been an explosion in fintechs that specialize in offering better versions of many services. As a result, people can choose from a range of providers and assemble a suite of products to meet their needs. This unbundling of financial services is putting the custom back in customer. But new technology isn't just giving people more options, it's also changing how financial services are made. Banks used to do everything themselves. Today, they can stitch together the best solutions from an array of fintechs that are focused on solving a specific problem better than anybody else. And it isn't just banks. Fintech solutions can be embedded into any company and reassembled to meet the needs of its customers. Thanks to all these advances, Farida can buy more fabric with working capital from a fintech. She can also save for her daughter's education with the savings account she obtained through her mobile wallet. The payments and delivery services embedded in her social media app can help her grow sales. And she can upgrade her sewing machine with asset financing secured against her digital income. These advances create new risks that need to be managed by regulators, businesses, and consumers alike. But they can also result in banking that offers lower costs, greater access, better products, and improved experiences for customers, including low-income customers. Whether these benefits are realized will depend on the choices made by businesses and regulators. To learn more and stay informed, visit cgap.org/fintech.
I hope that conveyed some idea of what unbundling and embedding looks like and why we think it matters for financial inclusion. And it's important to underline that this is not just a hypothesis. These things are happening already. One example is Grab, which is one of the biggest delivery and ride-hailing apps in Asia. And they're huge in Indonesia, among other places, where there are 95 million unbanked people and a whole lot more underbanked. In Indonesia, Grab offers a whole suite of insurance products to consumers. They started by offering accident insurance for trips taken with Grab, which is brilliant. Now they also offer health insurance, hospitalization insurance, even cover for COVID-19. But in addition to general consumers, Grab has a second constituency, their drivers. They also get various kinds of insurance cover. They get the same accident and health insurance options, but they can also buy income loss insurance in the case that the driver falls ill, has a critical illness or prolonged illness that means they can't work. And that responds to a specific and very important need that drivers have, but that consumers don't. And Grab actually has a third set of users, the shops, the retail shops that sell on the platform. They get the same health insurance options as the other groups, but they're also offered property insurance to cover damage to the shop, I think including in the case of natural disasters. They offer smartphone insurance, since many shops rely on their phones to, for instance, order inventory. So again, that responds to specific and very important needs that the shops have, but that consumers and drivers don't. So as you can see, Grab offers a range of insurance to three types of users right inside the app. So is Grab now an insurance company? No, of course not. They're doing all this in partnership with an array of different insurance providers, from AI-powered insurtechs to brokers to insurers who actually underwrite the risk. And it's not limited to insurance. They offer various kinds of lending products to both drivers and shops on the platform, again, tailored to the needs of those different users, again, in partnership with local banks who actually hold the loans on their balance sheets. And from a financial inclusion perspective, there are several things that are worth noting about this. One is that these are real microfinance products. That they are small ticket sizes. They have low costs. The premium for that health insurance is $1.50 per month, which is well within reach for many low-income people. Another is the sheer scale that these products are reaching. Grab claims to have sold 100 million policies, health insurance policies, in 2 years across Southeast Asia. And the core reason for that is precisely that these are embedded financial services. They are products that are tailored to solve specific financial services needs within a non-financial context. They're using digital channels and advanced technology to slash costs, and they are literally embedded within the user journeys of their customers. For instance, the ride insurance that I mentioned. The basic accident insurance cover is activated automatically during rides from the moment the ride starts until it ends. The moment a driver confirms a booking, he or she is covered. The moment a passenger gets on the bike or in the car, he or she is covered until the ride ends. It just happens seamlessly on the back end. In addition to that basic cover, people can buy expanded accident insurance cover to increase their coverage. That costs them 7 cents per ride, the cents. It is also activated automatically during rides, but you can turn it on or off anytime with a simple toggle in the app that you see on the screenshot here. So this gives you an idea of what we mean by both embedded and modular financial services and how these two phenomena often go together. Grab is not a financial services company primarily, but they see a variety of financial needs among their customers. So they partner with an array of fintechs and financial service providers on the back end to plug in products that are tailored specifically to meet those needs and which are seamlessly embedded within the existing app and user journey of their customers. If we look ahead where this is going, we see the market itself actually becoming more modular in its structure, probably organized around 4 broad layers that are central to financial services. Balance sheet layer around the provision of capital, risk management, and holding that risk on your balance sheet. a product layer around design and manufacture of individual products and services, a customer relationship layer around customer acquisition, sales, servicing, support, and being that primary brand facing the consumer, and a distribution layer of physical touch points that will remain important in a developing and low-income context for the foreseeable future. The point is that technology is enabling the unbundling of these four layers from one another, and that economic forces are then pushing things in that direction because different players have different strengths across these layers. Unbundling enables them to make different business model choices across the four layers. They don't have to do everything. Many are likely to specialize in a few layers where they have a competitive advantage and then partner in the others. And that leads to the emergence of entirely new business models and financial services. At CGAP, we've written extensively about that, what the models are that are emerging and which ones we think are relevant for financial inclusion. And I'll share a link where you can read more about that. But before wrapping up, this is all very interesting, I'm sure, but what does it actually mean for financial inclusion? Is this helping us make progress? We think it can because it helps to cut costs through cheaper acquisition, distribution, risk assessment. It helps to expand access through greater eligibility, greater affordability, and a shorter distance between the customer and the product, both digitally and physically. It helps create better products that are directly relevant to the context in which they are offered and more tailored to different users. And it helps create better experiences through simpler and smarter products that are easier to understand and easier to use. Of course, all of that speaks to potential. What businesses choose to do with it at the end of the day is going to be up to them. But we feel confident that there are enough incentives for different players to drive scale, that once these abilities are available, the market will push in every direction, including downward. Of course, this is also going to bring new risks. Regulators will have their work cut out for them over the next few years. Looking at consumer protection, market conduct, liability, transparency, concentration risk. Some of this might require entirely new ways of thinking about risk and about doing things for the financial authorities. But overall, we think this development holds a lot of promise for financial inclusion, and we look forward to working with industry, with regulators, with the donor community to make sure that we collectively live up to that promise. I have tried to summarize a very complex set of things in a short amount of time. If your interest has been piqued and you want to know more, we've written a whole lot about this, including the fintech space, the digital banking space, the role of platforms, unbundling and embedding. So just head on over to cgap.com/fintech. You'll find publications, decks, blogs, etc. that talk about this stuff. And feel free to reach out to any of us through the website as well. Thanks very much for listening. I now look forward to taking your questions and having a discussion about this.
Thank you, Peter, for this presentation and for sharing the results of this research with us. So let me open the conversation by asking you a little bit about this analogy that we saw during your presentation, the Swiss knife analogy that you referenced. Can you tell us a little bit more about that image, no? and how this unbundling of financial services that you were describing fits with the Swiss knife analogy?
Sure, happy to do that, and thanks again so much for having me. So with the Swiss Army knife, I'm talking about the increasing, growing array of products and providers that people have access to on the front end that they can choose to use, sort of depending on what their own preferences are. So maybe the best example to me is payments. I think probably a lot of the people on this call are using a whole bunch of different payments providers for different things, right? If we go back 20 years in time, most of us probably would have one credit card or debit card from our bank, and that's what we would use to pay for pretty much everything. I doubt that's how any of us is doing things anymore, right? When we're online, sure, we'll use our credit card, but we'll use, PayPal to buy things. We might have Amazon Pay. If we send things to friends and family overseas, we might use Remitly or World Remit or any number of providers. When we go out to eat, there are dedicated providers that focus on the restaurant space. We use our Apple Pay, maybe through our watch. We might use Facebook Pay. If we split a bill with friends, we might do that through Venmo. All of which to say that where there used to be, you have one financial service provider, and the products that you consumed were basically all taken from the menu that provider happened to offer you, whether or not it was actually a good series of offerings that they had. It's kind of what you were relegated to. But today, because of unbundling, it's so easy as downloading an app and signing in 2 minutes and creating an account to buy a product and start using it from any provider that's out there. And there are so many to choose from. And the result is that, I don't necessarily like the product that my bank is offering me for these different solutions, right? If I want to send money overseas, doing it through my bank is definitely not the best way to do it. It's not the cheapest, it's not the fastest, it's not the most convenient. It's just not a good product for most mainstream banks, the overseas remittances. And there are these great other products out there. They're really seamless, fast, intuitive, cheap, and work wonderfully. So that's what I'll use, right? So I'm in a sense then sort of swapping that out, right? To say, for the overseas remittance piece, I don't want what my bank is offering me. I want this other piece that World Remit or whatever company it might be, TransferWise, is offering me, because I think it's better. It meets my needs better, it suits my preferences better, and so forth. And so, today, most of us probably use at least a half dozen different payment providers. If we stop to think about it, we don't use one bank and one provider anymore. We use probably a half dozen different ones, and that's just payments, right? And so if we think about the same thing happening around other financial services and broad range of things, that's kind of what we're talking about here, what we mean by that Swiss Army analogy, that I can pick and choose for different products, different use cases, even which provider I think is the best one, and just use that. I don't need to be relegated to what my bank happens to offer me. Does that make sense?
It makes sense, definitely. And thank you so much, Peter, for your response. I think that we also want to be sure to involve the audience here. So let's go to some of the questions from the chat. So I see that Precious want to know a little bit more about the major drivers for these changes, this trend that you are seeing. What will be the main driver that you identify?
Yeah, so I had a slide early on that talked about some of those things. I think there are primarily a set of technology drivers. There's also a set of business model drivers that are sort of precipitating this change. The rise of smartphones is an important one, of course, right? Which create this really low-cost way of reaching consumers, a channel to consumers that is cheap and easy and flexible and quite rich, that you can do things well. Mobile phones, sort of dumb phones, created that functionality in a limited regard, and that sort of gave rise to the mobile money space. But smartphones create a whole set of new capabilities around that digital channel that is really powerful. The second I would call out is cloud technology, which has really changed the game on the back end, right? It means that's a big part of the reason why the cost of launching and running a startup has fallen so dramatically, right? Because if you wanted to build a bank or a fintech 20 years ago, you had to start by buying a huge, server farm somewhere, lots of physical hardware equipment that you would have to buy up front with your end scale in mind. I have no customers today. I'm hoping to have 500,000 clients in 2 years. So therefore, I have to size my hardware to what I expect to use in 2 years. So from day one, I need to have this expensive physical computer infrastructure up and running in a warehouse somewhere, and staffed, and security and all of that, which is just a massive expense for a startup to deal with. Cloud has changed all of that. Today, I don't need any hardware at all, right? I can just run it straight from the cloud. I can sit at my desk, write a piece of code, and run it on the cloud, and that can scale from 1 user to 5 million users without losing stride. And what that means is, because I'm only paying for what I'm actually using, which comes back to the software as a service business model. That's the foundation of the software as a service model, in a way, this sort of pay-per-use pricing model. So that is a huge reason why we're seeing this sort of explosion fintechs and the rapid rise of them, rapid scalability of the fintechs as well. So that's been a tremendously powerful force. I think APIs are really important, API-based architectures, and you could sort of unpack that a bit more to talk about service-oriented architectures on the back end of things. What they do basically is they enable you to stitch together different software components, either internally within the same system or externally with third parties, and just makes it a lot more seamless. Of course, 20 years ago, you could also plug together two software systems, but it tended to involve a fairly clunky and slow and expensive process of sort of building bespoke interfaces on both ends that could talk exactly to each other. So that was quite an involved process that was costly and slow and clunky, and that you couldn't really change very easily once you built it. APIs completely change all that, right? It's a simple specification. Anybody can write their software to match it, and off you go. And they're often very powerful, so that you can tweak those APIs and do things with them that were not possible in the old connection. So I think those are some of the important elements of it. AI and machine learning is super important as well on the capability side of things. There are so much that many of these fintechs are doing is built off of machine learning models of various kinds, whether sort of biometric identification or credit scoring, risk scoring, or projections, future projections for people. It could be sort of risk assessment, damage assessments that insurtechs are doing. Any of these sort of innovations, very often there's a foundation of machine learning that is the source of their sort of stellar capabilities, and is why those capabilities are also improving very, very quickly and making it harder to catch up for those who aren't on the ball from the beginning and aren't very focused on a specific thing. So I would call out those kind of technology drivers as being very important. I think the software as a service model that I made reference to earlier is important too, just making it much easier. Instead of a 5-year, $3 million contract with IBM, you can start with a fintech on a pay-per-use basis and on a monthly subscription. Which is very flexible and sort of tailored to the scale of your business, which just makes it so much easier to sort of partner with other companies and make use of these capabilities.
And Peter, so some of these changes that you are describing are likely to also probably bring new risk, no? And I see one question from Simon, that want to know if you can develop a little bit more about the risk that you see, particularly for regulators. That's what Simon is asking for, but also I will add, for incumbents or other players, no? So you have talked about the potential benefits in terms of financial inclusion, but we also are interested to know a little bit more about what are the risks that you envision.
Yeah, happy to do that. And just to say that I'm after the session ends, I'm happy to stay in the chat and answer some of the questions by text as well, because I see there are some questions coming in. So I'll go ahead and do that.
Thank you.
I think the risk aspect is really important. I think it's not all roses, right? There are a number of risks that regulators have to contend with. It's really important that they stay up to date on this space. Many of them have to do with the growing number of parties that are involved. In financial services, many of these fintechs are not licensed. They're not supervised by financial authorities because they're not banks, and they don't undertake what has traditionally been considered regulated activities. And that makes it harder to see and to monitor vulnerabilities in the end-to-end value chain, including on security and reliability, conduct issues, whatever it might be, right? It also makes it harder to determine where liability lies for any issues that arise, because there might be a whole string of parties that are involved in a given transaction. So who's responsible for things that go wrong? So accountability and oversight become more challenging. It could also create new kinds of concentration risk, ironically, right? Because this is all about spreading processes across multiple parties, but some of those parties might become really dominant in particular layers of the value chain, right? If one real-time authentication provider or whatever it is, or credit risk scorer becomes dominant in across a large portion of banks in a given market, then they can become systemically important, right? If that fintech goes offline, it could have huge implications for the entire banking system or big parts of it. So there are new kinds of concentration risk. I think there are potential risks to competition as well, though that sort of swings both ways. If a few sort of players on the front end control the customer relationship through these marketplace models that a lot of players are going for. It gives them a lot of market power that they could abuse, basically. On the other hand, it creates good competitive pressure on the financial service providers on the back end as well, which is a good thing. In extreme cases, though, there could be sort of risks to soundness and stability of financial service providers that become too disconnected from the end customer if they become heavily dependent on a single partner, right? So if I'm a bank serving Amazon clients with working capital, if 80% of my business is through Amazon, I'm in a difficult position suddenly with regard to Amazon. So there are a number of issues like that. There's a set of consumer protection issues around transparency, control, support, redress, and so forth that we could get into.
Thank you, Peter. Unfortunately, we are just about out of time for this session. So, Peter, it's been great to have you with us, sharing your insight on this trend towards more modular financial services. We look forward, as always, to having the chance to work with you again soon in the future. And audience, thank you for your attention and participation. I'm looking forward to the rest of the summit, and I hope to see you there too. So, goodbye for now.
Thanks very much. I'll see you in the chat, and go to cgap.org/fintech. We have a big paper out and a video out about this. So cgap.org/fintech, you can read a lot more there, but I'll see you in the chat right after.
Excellent. I will also share the link here in the chat. Thank you so much. Bye-bye.
Thank you.
Bye, audience.